If you're a founder that's fundraising and you're at all worried about how investors are going to be looking at your revenue, then this video is going to be for you. For example, did you know that 70% of all Series A companies have less than $1 million a year in annual revenue? And that 36% of all Series A companies have $0 in revenue, right? If you're a founder, you need to know these types of numbers to understand your company's valuation and better be prepared for fundraising. What's up, everyone? It's your favorite CFO, Logan, again here from Forecaster. If you're a founder and you're looking to stay up to date on all of the latest fundraising trends, then today's video is going to be an absolute must watch for you. So I'll be covering things like how much money is typically raised per round type. What's the average valuation for each company at each different stage? How much should you expect to give up to investors depending on the type of round that you're raising? If you watch this video all the way to the end, then I promise you're going to know exactly where your business falls in comparison to other startups and which round type is right for you in today's market. And since I'm giving you so much value, please do me a huge favor and like the video and hit the subscribe button so that we can keep bringing you this type of content. Let's go ahead and dive in. Now, when you speak to a lot of founders, there seems to be this lack of understanding in how they can determine a fair and reasonable valuation for their company or judge whether they receive an investment offer that's going to be fair for them. Because private deals are often that. They're private. It makes it really, really hard to evaluate your company based on industry norms with such a lack of readily available data. Now, this is even harder whenever you consider that things tend to vary pretty widely across different fundraising rounds, different company structures, different fundraising histories, etc. Despite all of this, there are typical broad bands for startups that are widely recognized and followed whenever it comes to things like valuation, revenue, and dilution. When it comes to figuring out if you're reasonable in your fundraising expectations or if you're way off the mark, my recommendation is always to go back to those broad buckets and see if you generally look like your peer group or if you're well outside of the norm. That's why it's so important to stay up to date on trends in the venture markets, because these buckets can shift with macroeconomic factors. Now, sometimes these shifts are relatively slight, but sometimes they can be really, really meaningful. Now, this video is going to make use of the most up-to-date data that we have as of 2024, but we're going to be doing our best to make this an evergreen resource for everybody and keep things up to date for our viewers, making sure that we make the proper adjustments if markets tend to shift. Now, we're going to cover 4 different key stages in this video, going from seed all the way up to Series B and moving from the earliest to the latest. I'm going to talk about 4 very important metrics and break the averages down by round. So we're going to look at the total amount of dollars raised, the company valuation, the percentage dilution, and how much revenue the company was generating at the time of funding. All of this data was provided by Carta, and we're going to link their resource below if you want to dig in further after watching this video. So starting with the seed round, which is the earliest round that we're going to cover in today's video, the median valuation was $12.8 million. Now, this valuation is fairly typical. According to Carta, this has stayed pretty flat for the past year. The median valuation on bridge rounds, which are the rounds that are raised between seed and Series A, also called seed plus or seed extension rounds, climbed to $20 million, which kind of makes sense, right? Because these types of rounds are typically happen at the very earliest part of the company's life cycle. This is usually whenever these types of companies are growing relatively quickly. Now, whenever we're looking at dilution, seed stage companies on average gave up 20.1% of the company. Again, this is pretty in line with historical averages, and I like to tell founders to expect to give up roughly 20%, give or take, in seed rounds in pretty much any market. Now, if you do a little bit of math, you'll notice that that implies that the average seed stage company raised $2.57 million. Things get interesting whenever you look at the average revenue composition for seed stage rounds. So according to Carta, the majority of seed stage companies, which is 53.6% to be exact, had no revenue at all. So if you're a company with some traction, but you have no revenue, this is actually really, really good news for you. The next biggest bucket were companies that had less than $1 million of revenue, and those were 34.9% of seed stage companies. Only 11.5% of seed stage companies had more than $1 million of annual revenue, which means that almost 90% of seed stage companies had less than $1 million in revenue. So cliff notes on seed rounds is this: if you have little to no revenue, that shouldn't be a blocker for you to get the round done, which is good news, I think, for all of us. So now let's look at Series A rounds. The median valuation for these companies moved up to $41.5 million. Now, that's a 3.2% valuation increase from the average seed round. Series A valuations have moved up relatively significantly in recent quarters, I'd say. So the average was as low as $35 million. That was back in Q2 of 2023. Now, the median valuation for bridge rounds, again, these are the rounds that were raised between Series A and Series B, climbed to $52.1 million. So it makes sense to see some growth here as well. You're still in those early days in the company's life cycle. Looking at dilution, Series A stage companies on average gave up 20.5%, which is very close to the average seed round round dilution. And just like the seed round, I like to tell founders that they can expect to give up roughly 20% in Series A in most markets. So those are all relatively standard. The valuations here would imply that the companies raised an average of $8.5 million during a Series A, which nothing shocking there. When it comes to revenue though, things get really interesting. So 35.6% of companies still had no revenue at the Series A, and 34.2% of companies had less than $1 million of annual revenue, which means that the vast majority of companies, 69.8% to be exact, had less than $1 million of annual revenue whenever they were raising their Series A. Now, whenever I first read this, I was like, holy shit, this can't be right. I always thought that $1 million of annual recurring revenue was the absolute minimum bar for a Series A. I've been in this industry for like 10 years, and it turns out that that's just not true. And I think that that's really important to keep in mind whenever you're raising a Series A, right? If an investor says that they don't want to invest in you because you don't have enough revenue, they're probably just using that as a scapegoat. Investors do that sometimes just as a way not to hurt your feelings and give them a little bit of optionality to invest in future rounds in your company if it really takes off. They don't want to invest, but they also don't want to piss you off and burn that bridge. So nobody said investors were known for their honesty. Anyway, 26.5% of companies had between $1 and $10 million of annual revenue, and only 3.7% of companies had revenue over $10 million at the Series A. For Series B companies, the median valuation moved to $118.4 million. That's a 2.8 increase in valuation from the average Series A round. The median valuation on bridge rounds, meaning rounds that were done between Series B and Series C, actually moved down slightly to $105.8 million. Now, this one was kind of weird to me, but I guess it's because raising a bridge round here may be seen as a sign of weakness. I don't know. Let me know what you think in the comments below. I'm curious to get other people's thoughts. For dilution, Series B companies on average gave up 16.7%. Now, this makes sense. As companies get larger and continue to raise larger rounds of funding, the percentage of the company that sold in a fundraise tends to fall. At this point, the company is probably fairly diluted, and it starts to make less sense to keep selling large chunks off. These valuations would imply that the average company raised $19.8 million at the Series B. Now, as far as revenue goes, almost half of Series B companies have between $1 and $10 million in revenue. Now, that's 48.9% to be exact. This seems to be the norm for this funding bucket. So if you're raising a Series B, you'd be best off to have some serious revenue. 42.6% of Series B companies had less than $1 million in revenue though, which for the record is bananas to me. I assume that companies in this bucket must have some seriously good tech or some crazy data, but still, seeing companies valued at around $100 million with less than $1 million of revenue seems borderline insane to me. Only 8.5% of companies in this bucket had over $10 million of annual recurring revenue. I was expecting that to be the norm, so seeing this bucket be that small was pretty surprising. Last but not least, we have made it to Series C. Here, the median valuation hit a whopping $195 million, and that is a 1.6x valuation increase from the average Series B round. Rounds that were raised between Series C and Series D moved up again to $180 million. The median valuation for bridge rounds, meaning rounds raised between Series C and Series D, moved down again to $180 million. Again, I assume that once you get up to larger rounds of funding, it becomes weird to raise these bridge rounds, so I assume that's why they're taking a valuation decrease, but again, let me know what you think in the comments. For dilution, Series C companies on average gave up only 12.9%. Again, this makes sense. You're getting into those larger rounds of funding, you're going to start giving up less and less of the company. This valuation would imply that the average company raises $25.2 million at the Series C. As for revenue, the vast majority of Series C companies, which is 58.3% to be exact, had between $1 and $10 million of revenue. 25% of these companies had revenue over $10 million, and the rest had $1 million or less in annual recurring revenue. Now, in general, the revenue composition here seemed low to me. I was expecting most of these companies to be over $10 million in revenue, but that seems to be par for the course for this analysis. In pretty much every round of funding, the companies had less revenue than I was expecting. Again, this is really great news for founders because it turns out that the bar for most fundraising rounds seems to be lower than at least I thought, but I assume most of us probably think. So there you have it. That is what the average company looks like for each round of funding. Let me know if you found this helpful in your fundraising journey. Leave a comment below. And if you want to hear more about fundraising, startups, and the venture markets, I'm going to be dropping a ton of free content here on YouTube. So please go ahead, like the video, subscribe to my channel, and maybe even hit the bell. And if you want to learn more about startups in general, check out the rest of my channel. I've got tons of videos on here that will help you become a better founder. Until then, keep building. We'll talk soon.